Yep, now we are live. I'm going to go on mute.
Okay, so good morning, good evening. We've been talking about the various economies, the various markets, etc., and how it is relevant to us as individuals. So I've been doing some work on in this area for a few years now, and I thought I'll share some of my experiences and what I observe specifically with respect to the Indian market, because that's something many of us are interested in, especially those of us who live in India or are either directly or indirectly connected with India in some form or shape, having some sort of stake on the ground. So I thought I'd share some of my insights into the Indian market and then we'll see how it goes. There'll obviously be a lot of questions, I'm sure we'll be able to address most of them in this forum itself. Otherwise, I'll probably circle back with appropriate answers. In the last few years, the Indian economy, really was projected to take off on a tangent upwards, which is a good thing to see, because traditionally, if you observe the Indian economy, with the help of the Planning Commission, starting with the first Planning Commission right down to seventh or eighth now, we've seen as what's traditionally called the Hindu rate of growth, which is around the 4% GDP mark, without any sort of participation by foreign agencies, whether it's FIIs, which is the foreign institutional investors, or the FDI, they're typically the foreign direct investment people. So foreign money, in other words, was restricted to a large extent, since independence, and since 1992, when P.V. Narasimha Rao, oversaw the turnaround of the economy, which was in fact, triggered off by Prime Minister Chandrasekhar's, then, desperate attempt to pawn the government gold and take us out of the balance of payment position, which we were in a very, very precarious position at that point of time. From there on, we have come a long way with the help of some sound policies on the ground over the last 20 years. And during the early 2000s, Goldman Sachs globally came out with the moniker called BRICS, which essentially included India into the top few growth large economies, and the focus obviously shifted into the Indian market in terms of both the stocks as well as business investment opportunities for the foreigners, and that also had a lot of ripple effect into the Indian economy, and the figures are there, which certainly says we have improved on our per capita GDP, etc. We'll touch upon those points in a minute. So I'm just giving the context so that we know where we're starting from. So there has been a lot of ups and downs in the last 10, 15 years. We had the dot-com bust. If I take the early 2000s, and then the 9/11 happened, and then that was succeeded by the housing boom in the U.S., and that translated to a lot of wealth creation in the U.S., and that had a ripple effect in the Indian economy as well, which was then slowly opening up for the rest of the world in terms of investment opportunities, as well as creating opportunities for Indian companies abroad as well. So it was a nice win-win as far as the Indian market is concerned, until 2008, when the financial meltdown globally happened, and India was not spared in that meltdown either, for obvious reasons. But we were sort of quick to stabilize right after that, and then we've seen some muted growth, but we've seen some growth nevertheless, and we hope to continue that tangent. Now, in this context, the last 2 or 3 years, people have been saying that the Indian currency, the Indian rupee, has been losing ground. We have made ourselves into a hole, and which is factually true, because if you look at the graph of the Indian rupee from independence time, 1947 onwards, it's virtually been a one-way street, which essentially is the way down. So the Indian rupee has been continuously devalued, and sometimes had to be devalued in steps, just to shake the markets out of slumber, and get some fiscal discipline into the system. So we've had some history there, but the long term Indian rupee versus US dollar currency shows a clear downtrend. So if you are an investor within India, you'll probably not be impacted much by this. However, if you're from outside, for every dollar that you invested in 1947 or even 1980, you're going to get back lesser dollars today, and that's the implication. I personally have been affected. I bought a property in India probably in 2008, just to give an example, and that property has, in nominal terms, has doubled. So which should be good news. But if I consider the fact that I invested with funds from Singapore, so in Singapore dollars, which was around 27, 28 at that time when I invested, vis-a-vis 47 or 48 today, all the so-called gains, the nominal gains that I get in the Indian market have been practically wiped off. So my investment has turned out to be lousy from a Singapore dollar context, though it is doing pretty well in the Indian context. So I just want to put this in perspective. So when you look at the currency and how it appreciates or depreciates over time, you've got to see it in the context of what's happening. So let's quickly jump into what the Indian currency has been doing. Very specific in the last 1 year or so, if you observe, ever since the new government has taken over. I don't think it's any credit to the new government, but it's just a sheer coincidence that the Indian currency has sort of outperformed the other world major currencies. So the table to your left would typically tell you that India's lost about 8% compared to, say, China, which was 4%. I'm sorry. 4%, but that was before the devaluation. So post devaluation, China would be closer to 6%. And India would be about 8%. So,
would you show us a slide, please? We see the first page still.
Oh, I've moved on to the second slide. Are you not able to see?
No. Can you click on that on the left? Oh, maybe we see the PowerPoint itself, and you're seeing the full screen probably. Maybe you should share that screen.
Well, it's already shared. So it says Google Hangouts is sharing your screen with plus.google.com. So
if you go to the PowerPoint itself, if you go, yeah, now we see it. Now we see it.
This is better.
Out of the presentation, with on the left side you see the slides. That's okay, I think.
Let me.
Yeah. So we are able to see the entire slide, but I think if we can convert to full screen, it will be great.
Yeah, I've converted to full screen now. I can see full screen on my side.
But I think, see, when you convert into full screen, we still see the PowerPoint. You're sharing the PowerPoint, but the PowerPoint has gone full screen, which we don't see as full screen, if that makes any sense. So can you click on slideshow on the top?
Yeah, that's what I.
Right. So now if you click play, maybe.
I'm putting a broadcast slideshow.
And then, are you sharing the screen or the app?
I'm sharing the full screen. Should I
see.
try?
So maybe the full screen doesn't take it. Maybe the full screen doesn't take it.
Okay, let me quickly switch over to. Okay, so that's the one. Are you able to see it now?
This is better. Yeah, we are inside the PowerPoint still.
Okay. So, does it make it any better?
It's a little better. Yeah, it's not the full screen, but that's okay. I think we can see it.
Okay. I think there's some technical issue. I'm not able to show you the full screen, though. I'm on full screen. My screen says it's already sharing. So
right. Yeah. Some
okay, so let's move on, and maybe we can share this PowerPoint in an appropriate way later on. I'm okay with that. So, okay, so if I just focus on chart number 2, so Lux and Gopal, I guess you're seeing this chart, right? Which has the caption: "The INR has been one of the best performers in 2014."
Yes.
All right. Okay. So the point here, guys, is if you look at the various currency pairs to your left on the table, the Indian currency has probably been one of the best performers, barring the Chinese yuan, which is around 6% post the devaluation that happened a few days ago, and the Chinese are threatening to take the yuan further down. So when I look at the currency performance in context, and when I hear the commentaries on CNBC or any other media that the Indian currency is losing big time, and there's going to be a massive repercussion on that. And, I don't see why all this hoopla about the fact of the matter is people don't look at it in perspective. Unfortunately, it is not the Indian currency that is losing ground against the US dollar. It is the US dollar that is actually gaining against the basket of currencies. That means if you look at the US dollar index, that is going up. That means the strength of the dollar is going up by the day as we speak, probably because of a flight of safety. As I see it, smart money that was there, outside of the US, riding on the near zero interest rate borrowing capacity in the US, and money that flowed into the other markets for for investment slash speculative purposes is all flowing back into the US as a flight of safety. This is a smart money, guys, and so that's where I see the US dollar gaining currency at this point of time, and that is reflected across the board. So if you see the table there are currencies that have performed far worse. Brazil, for example, one of the BRICS companies, has lost 54% of its value in the last year alone, and that's something massive. The Aussie dollar has lost 21%, as you can see. You see a minus there because the way the currency pairs are represented will be different, because this table talks about the most popular major currency pairs and the way they are looked at. So typically when you say AUD USD, you don't look at USD AUD, which will give the real picture from our comparison perspective, but that's not how it is traded. The most popular pair is the AUD USD. The rest of them, and the USD is taken as the benchmark against the smaller currencies. So that's why you see a few negatives there. But the fact is, most currencies have massively underperformed against the greenback, and as you can see, the euro, which is the biggest of them all, has lost almost 17% in a year. So when I put that into the backdrop, I think India has done fairly well in the last 1 year. Whether it's because of the policies of the government or is it because of any other reason, I really don't know. I suspect it's because of the fact that India has been consistently drawing money as an investment destination. I think that is what is contributing to the strength of the Indian rupee. Plus, a lot of people from outside also continue to pour in money, the NRIs typically. So that is contributing to the balance of trade position. This is not to confuse with the overall balance of payments position, but I think the Indian currency has done fairly well over time. So when this is in context of where the GDP is headed. So if you look at the chart to the right, India has been doing fairly well. So the dark line, the trend line that you see, the dark line, the big thick dark line, that is a trend line for the Indian GDP. And against that, I've also plotted the Chinese GDP in gray color, just to put things in context. So the reference for the Chinese GDP is to your right, and the Indian GDP is to your left. So
Dilip, one last try. In the slide in the bottom right, there is a full screen button. Can you try that as one last try? In the bottom right of the whole screen.
Yeah, I've already done that. So.
Oh, right. So that is the full screen. Okay. Because these things actually do take a lot of real estate away.
Yep.
Right, and I can't hide. I'm trying to hide the participants. I think we need to do it in individual screens. Maybe in the video it will come out better. So because it's a little bit harder to read. You've done so much work to do this.
You're not able to see it in full, are you?
So what we see is actually the slide with things on top. The ribbon is on top. So
let me unblock some of the toolbars to see if that makes it any better.
Yeah, that may help a little bit, but just give it one last try. I thought the full screen may
actually. Okay, I'm going again on the side scroll. You're seeing my slides, start slide, right? So I'm going on full now. Is there any difference?
So when you do, right, I think you're still sharing the PowerPoint application instead of the full screen, which is why we don't see the screen. We see the PowerPoint app. Is there an option instead of PowerPoint in Google Hangout to share the entire screen, or is that what you're doing already?
That's what I did earlier on. I've stopped it, so you must have seen it stopped at this point of time.
Yeah.
So I'm going to go to screen share. There's an entire screen button. Do you want me to take it?
Yeah, do that and then do full screen with your PowerPoint.
So your screen, are you able to see my screen now?
Now we see Hangout. Now if you go to the PowerPoint and then make it full screen.
Okay.
And do the button on the top right. There it is. Perfect.
All right. Okay. So you're able to see the figures now clearly.
Yeah. Perfect. Perfect. Yeah. Thank you.
Okay. So when I look at the graph to the right, the dark line is the trend line for the Indian GDP, and the gray line is the Chinese GDP in context. And the reference is to the right for the Chinese economy, and the Indian economy is represented on the left in terms of the numbers. So if you look at the way we have progressed, we had less than $1 trillion in 2006 in terms of the GDP. We crossed the trillion mark around 2007, 2008 timeframe, and during the financial meltdown, as you can see, 2008 to 2010, we sort of stabilized. We still didn't go down the tube. People are still years are clearly telling on the government, the then prevailing government, in terms of the ability to attract and grow the economy over the last 4 or 5 years, as you can see. And then now it is starting to look up, how far this is going to go. We do not know. The latest Citibank estimate is we're going to get closer to 8% than 7%. There are different views here, but the broad consensus is we're going to grow anywhere between 7 and 8% in this current fiscal. So that's where we are headed to. Now, is that sufficient or not? We'll see in a minute. When I put that in context with the Chinese economy, as you can see, guys, the Chinese economy in the same time, 2006, the Chinese economy is roughly where we are today. So if you look at the light gray line, the Chinese economy was in the 2 trillion mark around the 2006 time frame. So roughly 10 years back, they were in the same position as we are, which is okay. But from 2 trillion, they have literally gone on a tangent. They are about 5 times what they were 10 years back. So their economy in GDP, nominal GDP terms, has grown 5 times over in the last 10 years. And that's what you call scorching rate of growth, which is why people are massively gung-ho about Chinese economy and the ability to invest there. Whether they're getting the returns is anybody's right, but there is a growth, there is a market out there. Now, are we able to show any such rate of growth? Historically, since 1947, we have never had this kind of a growth the Chinese are witnessing. For that, we have never had the growth that we are seeing in this particular chart, even for the Indian economy. This has been really good, notwithstanding whichever government has been in power. The Indian economy has continued to. I personally don't think so. We need to do a lot more. And let me tell you why. I'm moving on to the next chart. So historically, again, when I look at the time that the Chinese loosened up their economy from a full-fledged communist economy during Deng Xiaoping's in a tenure in 1998 and 1978, 79 onwards. If you look at the exchange rate for the Chinese currency, the light gray line on top, you see that they have moved practically from about 1.8 all the way to about 8.5 or something around the 1995 mark. So that means they had devalued their currency to the tune of almost 80-85% in this period of time. And since then, they kind of held forth on a very steady. So it's a fixed exchange rate that they held between the 1995s to the mid 2000s, a 10-year period where they held their currency completely. And what is very pertinent here is look at the way the economy has taken off in the bottom chart for the Chinese. They look at the gray, dark, light gray line in the bottom chart. So that tells you a big story. The Chinese have been able to effectively use the depreciation of their currency to creating and attracting investments mainly in the manufacturing sector to be the world's manufacturer in the last 20 years. And look at that, put that into context and look at how the Indian currency is performed. And again, we have also done very similar. We were about 4 or 5 to the US dollar in the 1970s. Today we are at about 64 or 65. So we have done depreciation which is very, very comparable. But look at the way we have grown. That is very, very telling. So clearly, our policies, the government policies over the last 30, 40 years have not been geared up to take advantage of this drop in the exchange rate. The Chinese were smart enough, we were just not smart enough to take advantage. That's the message I wanted to give on this chart. Now, even with the appreciation of the yuan, and which was probably a fallout of the World Trade Agreement that China entered into in 2002, which they agreed to sort of semi-peg their currency to the US, and you see therefore a revaluation of the yuan from 8 point something to about 6 point something at this point of time. Even with an appreciation, they have still grown their economy fairly well, and that's a fallout of the massive capacities that they have created over time. So, is India in the same situation? Absolutely not. Do we have the manufacturing power today to take advantage of lowering Indian rupee conversion? We're clearly not. So we need to do a lot more work than we are at this point of time. If we are to take any advantage of the falling Indian rupee. Now let me quickly go to the next slide. Okay, so let's talk about the Indian economy. So where are we right now? As I said, 7 to 8% growth is given at this point of time. Domestic consumption-driven economy, unlike the other Asian economies like the Chinese, the Korean, the Japanese, etc. This is a high domestic consumption-oriented economy, which is a good thing by itself. If I mentioned the word Hindu rate of growth, which was a very common moniker amongst the economists in India. The Hindu rate of growth is around 4 to 5%, and we can sustain at any given point of time that sort of growth. Even when there is a famine, not just a drought, I think we can go down to 2 to 3%. We have that resilience in the economy to move that. But unfortunately, the upside is something we are not able to take advantage of because of the various policy hurdles, which you will see in a minute. FDI is increasing, which is again good. This year, we got about $30 billion, something we've never got in any of the preceding years, which is good to see. But when I put that into context in the Chinese economy, which is still attracting $200 billion in the same year, we are nowhere near the Chinese economy in terms of the ability to attract foreign funds. So we need to do a lot more work there. The demographics for India are very, very favorable. We are a young population, relatively speaking. But that has a negative connotation, and I'll come to that on the what's not side and to the right. Increasing per capita GDP. So we are now about $1,300 to $1,400 per person, up from the $700, $800 about 10 years back, which is good. Which is also seeing a lot more people coming out of the poverty line and joining the middle class / lower middle class stratum, which is good to see. And if you really need a proof of that, you go to any village site today. People are materialistically a lot more prosperous than they were in the earlier years. We have a more favorable mix of agriculture, manufacturing, and services than we ever had in the past. If you go back to the Indira Gandhi days, our contribution to the overall economy by the agriculture was almost 65%. So we were completely monsoon dependent and an agri-based economy, and we screwed it up further by saying self-reliance, and that was the mode of those days. While that may have been the need of the hour at that stage to make sure we are stable, that never gave us the sort of long-term focus that we really needed to have in order to catch up with the likes of China. and we are just trying to play catch up at this point in time as we speak. So we have a more favorable mix of the three sectors. Now agriculture contributes to about 30 to 35% of the overall economy, which is good. Manufacturing is the biggest chunk of them, followed by services, and then followed by agriculture. That's the way it is now, and that's the way I believe it should be, because if we need to get our the economy to the next higher level, we need to start focusing much more on manufacturing services than we are today. That really means the share of the GDP contributed by agriculture will progressively come down, and that's the right way to do. What's not working, and this doesn't need too much of bashing here. We know the physical infrastructure is comparatively very poor. When I say infrastructure, it's not only the swanky roads and telecom and things like that. It is the basic thing at the rural side as well as on the urban side. Things like, say, water management, health, sanitation. We're hardly spending any money on those critical areas, and that is an opportunity for us. How much we are able to take advantage, only time will tell, because the government policies, as I see them, still not aligned to take advantage of some of these deficiencies and spend our way to growing the economy in these areas. So that leaves a lot of scope for investment in this critical area. Of course, there are some areas where we have done miraculous progress. The telecom clearly is one such area. The roads have improved by and large between the big cities. We still need to make some inroads, literally speaking, into the hinterland, and I believe the government is now starting to release some of the road contracts. Just to put things in perspective on the road, because of all the scams that we have seen, the corruption charges and the court cases pending with the different courts in the country, practically almost all of the infrastructure projects were stalled over the last 3 or 4 years. They are now slowly getting released one by one. The roads contracts are getting released. The last I heard was about 30,000 crores worth of road contracts are being finalized, out of which about 8,000 have already been released. The balance are expected to be released between now and March, which is good for the infrastructure sector. The power is still in a limbo because the power is intrinsically linked to the coal sector as well, and coal mines have completely been frozen by the Supreme Court. So until and unless that is released, the power sector will not see the light of the day, literally. So there are some critical areas that we need to work on. Infrastructure is certainly one of them. The corruption charges obviously are putting a big hold on the policy decisions and the approvals by the government, and that really has to change if we need to get our economy on the fast track. Lack of social security. This is the downside of the favorable demographics that I was talking about. We don't have a social security mechanism in place, unlike much of the West. The government is taking baby steps, things like individual insurance. Some state governments have done that. The Tamil Nadu government under Karnataka did a good job of getting the poor covered under insurance. It may have been a small one, but it is a step in the right direction, in my opinion. There are other state governments who are also embarking on similar things. The Modi government also has embarked on an insurance scheme for the larger poor and the unaffordable people, so which is expected to trickle down into the overall economy. So there are some baby steps being taken, but with the fact that there is a social change happening within the fabric of the society, we need to make some quick and rapid steps here to ensure that our elders don't end up on the streets. And that's something we need to work on. There's a lot of opportunity there, but there's a lot of risk that the economy poses there as well. Employability of labor. This is something that has always been complained about, and I completely subscribe to the view. We know this, guys. There are so many colleges that produce graduates, engineers by the hundreds of thousands, but how much of them are really employable is a big question. We've seen comments by Narayan Murthy and all those bigwigs in the IT sector, who talk about the fact that almost 70 to 75% of the graduates who come out of colleges are just not employable in any in a corporate organization. It's not the language; it's a lack of understanding, the lack of ability to articulate. That's a big issue. We are missing big time, in my opinion, on vocational training. If I look at the Chinese economy, the only reason they grew was the guys from the rural side, the poor farmers, the illiterate guys, or the semi-red guys, were picked up and trained on vocational courses. So if I am good in, say, smithy or lathe, something like that, I become an expert in that area. I just get trained, and I do that for the rest of my. That's also the German way of doing things. You get into a shop floor. When you are 20, 25, you remain in the shop floor until you retire. That's the German way of doing things. Now, we are seriously lacking vocational skills. Everybody seems to think an engineering or a medical degree is the only way to nirvana, which clearly is not, because if we have to become a manufacturing power in the future, we really, really need vocational training. Guys who can work in the factories, guys who can work in the textile companies, the toy manufacturers. It could be anything, but you need vocational skills, and that has to be ramped up, especially from the rural side. You see a lot of rural youth that are unemployed or underemployed in the fields, and that has to change if we have to make any dent in the progress. Stable policy and tax regime. This has again been a very, very sticky point. The previous governments subsequently changed their policies up and down according to whims and fancies. This new government, to me, appears to be no different. So we're just continuing on the wrong path that we have been doing in the last 60 to 70 years, and I think it's high time we change that. So that is an overall backdrop of where the economies are. Let me pause here for a second to ask if there are any questions.
No, Dilip, it's going well. We can hear you properly, and it's full screen. We are just taking it all in, so maybe we'll come to questions when we reach more numbers.
Alrighty. Okay. So now let me get a little more micro and see where the stock market has performed in this backdrop. So again, I took almost a 10-year view of where the stock markets are, and when I look at where we are, before this last round of correction of the last few days, the PE of the Nifty is around 23.5. And the median P historically for Nifty has been around 18. For Sensex also has been very similar. So if I were to look at where the Nifty is headed, where the stock market valuations are headed, we are clearly about 30% or 25 to 30% in terms of overvaluation at this point of time compared to the median numbers. And when I put that into context with, say, China, which is still about 13 to 14 even at this price, or some of the other economies which are still around 10 to 12 for their respective indices, we are certainly overpriced. But again, historically, India always has been consistently overpriced. So there's nothing for us to lose sleep here. I just want to flash this screen with the objective of saying, if I'm an individual investor, what is my risk reward? At this point of time, the rewards are sort of dwarfed compared to the risk. The risk is way too high. So the returns that I can expect from the stock market purely based on an investment in the index stocks is likely to be muted in the future years. So that's the message from this. And again, if you look at the small table to your left, this again has been Nifty's returns over different PE levels. So given that we are around 23, 22%, 22 in terms of PE, the numbers aren't looking good. So what that really means is, if I invest in the index stock exactly based on the weightage of the different stocks in the Nifty, and I should end up about 14.98% negative growth in the next 3 years. That's what the historical numbers really say. But again, it's a matter of where we are and where we want to go. And this also assumes that the current rate of earnings by these index companies will stay where it is, which is also not true. So more than a PE, the new measure called the PEG, or price to earnings growth, would be a better better parameter to check this. But typically people tend to look at PE and say where we are, and is this a fair valuation or not. So purely based on current valuation, it's high priced. Whether it's going to grow, as I said, with 7 to 8% growth, there's no reason the PE also should change. So the consensus is the index companies will grow anywhere from 10 to 15% on the individual basis. There are some bad apples in the index, and that is also contributing to the overall numbers getting pulled down.
So, Dilip, the PE study, right? So, have you seen a similar study in other markets, especially US? Now, you're saying at a PE of 23.5, the historical average is minus 15%. But as things change, don't they change? The first question is about the US markets. Have you seen a similar number?
Yeah, I mean, most of the funds, Vanguard and all those guys go by what the index say. If you look at Russell 2000, that clearly calculates this. And as I said, the numbers vary anywhere from 10 to 14 depending on how these different people value them. So US market is certainly lower priced than the Indian market. But then again, traditionally, if you look at any emerging market economy, there is a premium on the prices. So which is why I said there's no reason for us to lose sleep over these numbers. But the point is, and I want the team to be aware that we are on the higher end of the investment opportunity here already, and therefore from here on, the rewards, if I were to invest as a new investor, compared to the risks I'm taking, are fairly very high.
Fair enough.
Okay, so how do the different classes of assets perform in the Indian market? How are they performed on the last few years? Let's look at a quick set of numbers here. All these numbers are post-tax, so that means there's always a taxation on some of the asset classes, but net of it is the Sensex or the Nifty has returned about 14% annualized return since its inception in 1979. And this is specifically with respect to Sensex. Nifty came much later. So over the last 36 years or so, if I take the compounded annual growth, Sensex has returned about 14%. Now, this is the nominal number is actually about 16 to 17%. I have factored in roughly 3 to 4% down to factor in for the fact that we used to have capital gains tax even on long-term holdings in the past. I really don't have the way to calculate that. I'm an amateur here. But if I work in an economic organization, I should be able to get the numbers. I suspect it'll be around 13 to 14% in the adjusted scenario. I think around the 2000 mark, we did away with the long-term capital gains in the Indian market. So that means if you hold stocks for more than a period of 1 year, any sale after the 1 year period attracts zero tax. So this is a post-tax scenario of roughly about 14% annualized return from the index. So if you invested, say, in Colgate or Hindustan Lever in 1979, your portfolio would have seen an annualized growth of roughly 14%. Again, these are individual stock specifics. If you invested in the index either through ETFs or mutual funds that focus purely on indices, then this is what you can reasonably expect. Compared to that, you look at PPF. It has consistently had high single-digit returns, and again, these are post-tax, tax-free money as long as you take it after the 6-year moratorium that PPF imposes. So you can take only in parts, not in full, if you want to avoid paying taxes on that. Real estate. This is a very interesting thing, guys. People think that we have made a killing in the real estate, right? People think that my property has gone up five times, 6 times over, etc. If you look at the long-term view, it's anything but attractive. Just as an illustration, if you bought an apartment in Mamalam, say at a cost of 1 lakh in 1979, just put a compounded rate of 12%, you'll get to 1.2 acres, which is roughly the market price of a decent apartment in Mamalam today. I'm still on the higher side. If this number drops, to factor in the fact that if it's an apartment and you're going to have depreciation on the building, then the number would look lower. But then people will argue that if I had bought an individual house with the land, the number could be much higher. So I'm just trying to take a moderated view here. But the point here is this 12% annualized again, is not as great as it is made out to be. Now, this number is post-tax. Pre-tax, this number should look more in the region of about 14 to 15%. There is a long-term capital gains of about 20% on real estate. So that means if you had bought the house in 1979 for 1 lakh, there will be an adjusted index, adjusted cost of living, adjusted cost of acquisition that will be recomputed by the income tax department, and then the nominal sale price as on date less the adjusted cost is what will be considered for your tax gain. So if 1 lakh versus 1.28 crores may not be the actual amount for taxation purposes. The 1 lakh may look more like, say, 70, 80 lakhs in today's context, just to put things in perspective.
Now, this is one of the best comparisons I've ever seen. I think this is something that people have in their minds, and I don't own any real estate, but I, see this conversation coming up all the time. Now, this is historic. Where do you think we stand now, given that the market is a bit frothy and the real estate market is stagnant? Where would one invest now between the two?
Well, I would still think the index is the place to be in. The Sensex is the place to be in. I would say I'm coming to that. Just hold on. Now we are coming to where we need to invest, etc. So let me quickly run through the chart. So if I put that the FDs in context, it's about 6% post-tax, because FDs typically give about 8.5 to 9% pre-tax. If you are on the marginal, top marginal rate of taxation, you get about 30% off that, so it's about 6 to 6.5 is all you can hope for through FDs, and that's barely sufficient to beat your inflation. So in real terms, adjusted for inflation, your money isn't growing in fixed deposits. Gold has performed slightly better, but again, gold has its own problems. Liquidity is one. Unless you go into either ETFs or hold them in pure bars, the wastage on gold, buying and selling jewels, is so high that the whole proposition becomes unattractive. So that is a drawback of gold, and we would like to please the women folk at home, so we end up buying the jewels, which is good for the women, but not good from an investment perspective. So if I have to look at gold as a class of investment, it's an absolutely lousy class of investment. The advantage of gold, though, is in terms of crisis times, when you really have nothing else to bank upon. Gold is the de facto currency that you can really look up to and sell off in crisis times. So those different classes of assets tells me that the stock market is still one of the best places. Real estate is not bad at all, but it's not as great as people make it out to be. That's the whole point here. So if I were to look at, assuming that I would really want to get into the stock market, so given that it's widely projected to be on the way down, Lux and Gopal and the others, I shared this on Facebook a couple of days as well, right? The 200-day moving average for Nifty is not looking good. The same I'm seeing with Nasdaq as well, Lux. So the technical, from a technical chart perspective, the markets are projected to go down. Whether they will actually do or not, no one knows. But the charts have never, lied. That's the consensus. Now, how far it will go, that's anybody's guess again. But again, my own analysis, and I've written an article on my blog about 5 or 6 years on this. Historical data clearly points to the rule of 1/3, which is from a peak of a bull market run, sustained bull market run, like what we have seen in the last few years. The U.S. market has had a sustained run for at least 5 to 6 years now, which is phenomenal, never seen before in the U.S. Market history. Right. So when you look at a sustained rally like that, typically when it falls and corrects badly due to large events, it goes all the way to about 1/3 of its original value. It's just very scary. But again, if you just hold on to it, it's not going to look as bad as that. In fact, I look at these drops as an ideal point of entry. Now, what is the right point is very difficult to pick. Wait,
Dilip, though, 30% is high. 10% is a typical correction. 30% is much more than it. You talk as if that's more common. Is that true of Indian and outside markets?
No, it is not common at all. And all I'm pointing out, Lux, is to the fact that we have had a sustained bull run over the long-term period. 5 to 6 years is a long time in any stock market history, and therefore we are in due for a correction. And I know you would quickly jump in and say that's what all the pessimists have been saying. Yes, that's the pessimist's job. A bear will typically beat the market down in order for them to gain. That's as parochial as a bull would do. So and bulls and bears would do what they will do. but when I look at the charts, very dispassionately, from the peak, it's let me quickly shift back to the Indian thing. You look at the number here, 2008 to 2009. 2008 was almost 20,000 in the Sensex. And look at where they have fallen. They've gone all the way from 27 or 28 to about slightly about 10 or 11,000. That's where it was. I clearly remember the Nifty fell from 6,300, which was the peak at that time in 2008, all the way to 2,200 or something. So it was roughly 1/3 of the number. And this is something I've seen in the Hang Seng market in Hong Kong. I've seen it in Korea. I've seen it in Japan. I've posted this in my blog about 5 to 6 years back, and it still holds very, very true. So does that have to scare you? My answer is it all depends. If you have put your money in cash and if you are not able to hold on into the market, then there's a problem. But if you put your 401k, for example, Lux, and if you can afford to just wait it out and let the markets get back, sure enough they do get back, and they go on to surpass their previous highs over time. So in the long term, there's nothing to really panic about in the markets. The moot point is, as individuals, do we have the wherewithal to withstand a downturn and stay put there, and if possible, add to a position so that we sort of average it out based on our conviction and bring our overall cost of ownership down. So that is the key question here. So a pullback or a correction or even a recession in the stock market doesn't really have to worry us. What should worry us is if this stock market correction is combined with a severe downturn in the economy, then that should really, really worry us. A geopolitical event, for example, a 9/11 type of attack, should actually be an opportunity. It should not be deterring us. But if it's a 1929 kind of a crash, then we better start worrying about it, right? Because many companies have gone under in 1929, and individuals have come to the streets. I'm not scaring this away, but we just need to be watching out, make sure that we are not in that situation. At this point of time, I don't see any of that happening, unless there's a major geopolitical event happening, or the U.S. economy unraveling really fast. I don't think that situation is going to come. So I really don't think we need to panic at all. So how do we play in this market, assuming it's going to go down? There are three tenets here. One is, don't put your money in one stroke. Accumulate. In a stock analyst parlance, it's accumulate means you put small amounts of money on a stock or an index that you're convinced about fundamentally over time. So that means if I like LNT, for example, I don't go and buy a lakh of rupee worth of LNT today. Instead I buy just 3 shares today, 3 shares in a week's time, 3 shares in a month time, and so on. So I sort of average out the cost of ownership, provided I'm convinced about the fundamentals. Don't go and do this strategy to a stock that has seen its fundamentals change materially. That could impact your ability to hold on and make money. And I'll give a couple of examples there. Amtech Auto was one of those stocks which the bulls tried to push it up. From 70 or 80, it went all the way to 250 or 260. People bought it there. Today, there's a lot of negative news about Amtech Auto. That stock has been hammered down back to 60 or 65 from 240. So if an investor had bought at 240, he would have seen 75% of his wealth eroded. So what does that individual do now? Does he go and average out and buy more stocks? Maybe if he's technically really good, look at the ability to read the technical charts, he may say, yeah, I see an opportunity for the stock to bounce back short term. So let me go, add to my position and square off as quickly as I can when the market bounces. But unfortunate part is such bounces are typically what's called dead cat bounces. That means they bounce for a period of time and then they just go down further. So you got to be extremely savvy to take advantage of that ride. So what is prescribed for individual investors typically is, if you see the fundamentals changing, book a loss, get out, and get into something that that you believe is fundamentally sound and will get will help you make over that loss and hopefully make more money over and above that. So what do you have to do for that? You have to watch the Nifty very closely. If you aspire to be an individual investor, that's that's all you can do. You really don't have any other choice. Also, the growth side. People look at the PE and say, well, this is high price, as I explained. That doesn't have to be a cause for alarm. If the economy, if the index companies and the overall Indian corporate growth is still fairly robust, there's no need for us to panic. What we need to do is to see whether this 20 to 23.5 is going away to 28 or 29, which really means we have to start worrying. But if we're going to factor in the 15-20% growth for the 23, I think we're still okay. Right. So the key here is put things in perspective, see what the expected growth of the economy is, and see whether the valuations are fair or not. Now, the couple of questions that will typically come back to me is, how do I know economy is growing? There's no real ready-made answer for it. You've got to read the media, you've got to read the various news that are coming out, you've got to read between the lines if you have the ability to do it. You've got to watch very closely to assess whether the economy is really stated to grow or not. Now, if you stop me here for a minute and ask me whether the economy is likely to grow, I see no reason why it cannot grow. There's only one risk that I see at this point of time, which is the geopolitical risk. People say the monsoon is a big dampener. Monsoon will be a dampener to a certain extent, but it's not enough to pull us down drastically from 7 to 8% growth to say 2 or 3%. We are not there yet. So maybe a percentage or two. So 7 to 8% may become 6.5 or 6 at worst, assuming that it's only the monsoon. But if it's a geopolitical, if it's the China meltdown or the American meltdown, as people are speculating now, then it's a different cup of tea altogether. Right? So that could dampen it, but that also could be an opportunity, as I explained. So if you're not sure, and if you don't want to dabble in all this, if you say this is not my cup of tea, I don't want to waste my time on looking at individual stocks, then just pick mutual funds, the ones that you think are really good. Start an SIP, which is a systematic investment plan, which is again the averaging out strategy that I talked about. Every month you buy in a very disciplined manner a certain number of units of mutual funds or a certain amount of money in rupees. And say every month I'm going to say, for example, put in 5,000 rupees or 10,000 rupees in a particular mutual fund. I may have a basket of mutual funds like 3 to 5 and keep putting money into it, and don't worry about the fluctuations in the market. The mutual fund guys are there, they will do the job for you. The returns in a mutual fund typically are lower if you go through them compared to if you are a savvy investor. The operative here is a savvy investor. 99% of us are not. We think we are, but we are not. So we just need to be careful here. Okay, so what does it mean? What does it take to be in the stocks? It really depends on the individual's risk appetite. Guys, I know most of us are 47, 48, 46. What are the ages? But we are in the middle life, and if you look at a super cycle of investment, we have already crossed 2 super cycles of investment, which is 15 years each. So we've already done two cycles. We've got one last leg of a super cycle, which is 15 to 20 years, at best, for us to make any meaningful money. So it's either now or never, because as you age, your proportion of money in the stock market has to go down. And why is that so? It's your ability to manage risk as an individual investor. If you can leave the money with with mutual funds and let them do the job for you, then again you're putting your money on a third party and hoping that they will make the money for you going forward. But again, that risk is limited to that risk is dependent on the performance of the stock market itself. So mutual funds may still outperform, but they may not be good enough to give you the kind of returns that you're looking for, especially in the retired years. So that presents a conundrum, and therefore, traditionally, financial planners have always advised that as you age, your proportion of assets in the stock market should progressively go down. I'm not saying you should take it to zero. You can have a small percentage, say 15-20%, when you're 60, 65. But until then, you can still play around. Look at this as one last super cycle opportunity for you to be in the market and make the maximum out of it.
I think one rule of thumb people use is take your age, subtract your age from 100. So if you're 20, put 80% of a thing in equities. If you're 50, then put 50% in equities. Would you agree with that?
I wouldn't quite, for the simple reason that applies to a more mature market like the US. The Indian market, there's a lot of fluctuation. ITC, for example, has fallen like 30-35%. Just being stock specific here, about 35% in a matter of a couple of months. That's one of the key index stocks. And why did that happen? They increased the excise duty by about 5%. So, the point I'm trying to say here is the irrationality in the market in Indian scenario is very, very high compared to what you see in a more mature market. So, if one has the ability to bear those shocks and even add to their positions, then sure, one can do it. But one should be ready for these shocks, and as you age, your ability to take those shocks start going lower, which is why I would think around 60 to 65, your portfolio in stocks should not be more than 20% direct stocks. What you can do though is there are many bond funds which will give you better than FD rate of returns, and there are some blended funds which have about 20% in the market, the stock market, and the rest in bonds. You can put them, and they will typically give you a couple of percentage points returns more than a typical bond fund would. So there are some products that would help towards the retired age, especially in India.
I agree with what you say about the risk appetite needing to be higher in Indian markets. One slight twist I would add is, the younger we are when we take risks, the longer we can take the risk. I think.
Absolutely.
So I think So even if we didn't do it so far, maybe it is time that we do. So we actually get into familiarizing ourselves with our own risk appetite and the market's risk appetite, and kind of bridging the two. So that would help. Sorry to interrupt.
No, absolutely. That's a very pertinent point, Lax, and that would be my suggestion to our sons and daughters who are going to see this or hear this. If you're 18, 19, 20, whatever your age is, and you start getting money, by way of gifts by your relatives or your birthday gifts or whatever money, start investing a part of them. Of course, it's your age. You have the right to blow up some of that money. That's fair enough, but get the discipline of putting a little bit of one portion of the money that you receive into some systematic investment mission, whether it's a stocks or fixed deposits or whatever you think is fair. Get into it, and as Lux rightly said, the earlier the better when it comes to stock market. Absolutely, no two views about it. Okay, so last couple of points here. Trading versus investment. Again, this is an often misrepresented terminology. People actually are traders and they call themselves as investors, which is completely wrong. When I say investment, it has to be with a long-term perspective. Investment is like imagining yourself as investing in a company as a shareholder. It's not just buying a stock and selling a stock. That is trading. Trading becomes a commodity in the stock market when you treat the stocks themselves as commodities, right? Contrast that with investment. So if I buy the Hindustan Unilever story, that means I'm buying into the philosophy of the company, and I want to get in there as an investor. I will stay there for the long term. When I say long term, how long is long term? A minimum should be 3 years, in my opinion. But typically you should hold it for 10, 20, 30 years to see your wealth really grow. How do you pick those 5-star stocks? That is an art. I haven't mastered it myself. I have done I've got it right in a few stocks. I've got it wrong in quite a few stocks. Thinking that they would be the next Unilever. I've done my share of mistakes as well. But I'm an amateur, so I've learned it. Luckily, I've not burnt my fingers, which is fine. Choose the right investment class. Again, you got to be very, very choosy here. As I said, 20% when you retire. But at this age, mid 40s, you can still go to the tune of 40 to 50% in stocks. There's no reason why you cannot be there at this point of time. As I said, just watch out for where the indices are headed, where the stock markets are headed, where the economy is headed. At least keep the headlines in the back of your mind and take a judgmented call. You may be right, you may be wrong. Only time will tell that. No, let me ask you. Let me put the scenario. If I have made say 15% in my mutual fund, and I see that the indices are going down as of today, do I pull that book the 15%, or do I say, well, this is a short-term correction and it'll pull back and not really do anything? That is a tough call. Nobody can make a call for you. You got to make that judgmented call for yourself. So in hindsight, if I had pulled out my money today, I may see the market going down further, and I may pat myself on the back and said, well, it was good timing. I was fortunate to get out. Or if I see after that I pulled out, the market correcting to a certain extent and then pulling back fast and much more than where I sold off, then I would curse myself and say, gee, I should have stayed down. So these are very tough calls to make. This is where we as amateurs typically fail. The exit point is tougher than the entry point. I can do all the hard work to get an entry point into Unilever. When do I ditch Unilever and move on to another company? That is the toughest call. In my 20, 25 years of being in the market, that has been my toughest call as well. When do I exit? I have got my big picture correct most of the time. On the individual stocks, I have not got them correct, and that's been my experience as well. Okay, so this is the individual tenets for investment, whether you're in the stock market or any other area. The individual needs to have a structured financial portfolio. It could be any level of income. Make sure your financial objectives are met through a structured financial portfolio. When I say a structured financial portfolio, what do I really mean? I need to factor in what my income today is, what my savings are as of today, and what my projected income / savings are going to be over the foreseeable future. Now, when I talk about foreseeable future, in our case, given that we are in the mid-40s, I would say up to the next 15 or 17 years, until retirement, what is the likely funds inflow from my regular source of income? What is it likely to be? You can factor in things like your expected increments if you're in a job, or if you're expecting a windfall in a startup, 5 years down the line, factor that in. That's fair enough. But have a plan and see what your against those income levels, what your likely expenditures, the big ticket items are. Some of you may still want to buy a house. Some of you may want to keep money for education of your son or daughter, for their marriage. There could be big ticket items. So you've got to factor in them and say, these are my objectives, and therefore these are my likely cash outflows in these years. Now, if you have a good broad picture of that, you will then be able to say, okay, I need X amount of money in this year approximately. I will get Y amount of money in this year for investment and so on. That will give you a very good window of when and where to invest and when and where to pull out from. Without this plan, you're going to create more mess for yourself and put yourself into a hole. So my humble request to all of us is get a plan, and this is something only you can do. Nobody else can really help you. Talk to a financial planner; they'll come and give you all sorts of bullshit. I've done these financial planner talks many times, and I'm not convinced with the way they look at things at all, because they go with a lot of thumb rules, which I find them absurd in my personal experience. So back to the stock market, how much should I have? We covered this earlier on. It should reduce over time, 30 to 50% at this point of time if you're fairly okay for risk. But again, if you're conservative, you don't have enough disposable income, then I would say reduce it as much as you can in the stocks and keep them safe, because the first and foremost is financial security and safety. Investment and growth is only after the financial security and safety are ensured. So don't take undue risks than what they're due for. And this again will be dictated by your financial portfolio. What really you can afford and what you cannot. That's something that will come out of it. Based on that, you take your judgmental call on how much risk you really want to take. The third thing that we all need to factor in is, towards your retirement, start aiming for annuity income. And it could be income from rental properties. It could be from dividends from stocks. It could be dividends from mutual funds. It could be fixed deposit income. It could be any class of assets that will provide you with a constant monthly retirement annuity that will keep your monthly expenses going. Remember, it's just you and your spouse at that time, and kids are probably out of home by the time you're 60 or 65. So make sure that you have enough financial security at that point of time to be able to take care of yourself and stand on your own feet. And for that, you've got to plan from now to create that annuity. For example, if you already have one house, you may want to consider buying a second house. It may not give you great investments as of today, but that is a damn good avenue for you to create that much needed annuity income. The monthly rental income from property. So that could be one way to look at it. I'm not saying that's the only way. You could even put that into stocks and high yielding, high dividend yielding stocks that could give you a decent return. Again, the point here, guys, is in the Indian stock market context, the dividend yields have been pathetic. Contrast that with say what you get in in the US, Kinder Morgan, for example, gives 4 to 6% on any given year as a return, and compare that with the official rate of inflation of 2 to 3%. I think you're just fine. That's a damn good investment yield. Johnson & Johnson gives you damn good investment dividend returns there. Contrast that with what I see in the Indian market. The yields, the maximum yield I've seen is about 1.8%, and contrast that with the actual inflation of about 10%. You're not getting anywhere by investing in dividend stocks, and which is probably why nobody talks of dividend stocks in India.
So, Dilip, why is that? So, in the U.S., where the interest rates are typically low, and you're talking about J&J and others, we're talking in the neighborhood of 2.5 to 5%. In where interest rates are typically very low. In India, where interest rates are pretty high in the banks, so the dividends don't compete at all.
Yeah, there are a couple of reasons. One is the real rate of inflation, which is much more. So if you have to really beat the inflation, your dividend yields should be more than the 10% that you're staring at. And no company typically gives a sustained 10% dividend year on year. That's impossible. The second thing is in terms of the economic cycle. This is the more pertinent point. In terms of the economic cycle, the US markets are a lot more mature. The Indian companies are a lot less mature in terms of the maturity of the economy. So that really means that there's a potential for investing into new business and growing it rapidly. By that, what I mean is the dividends, which are nothing but the profits from any enterprise after all costs are factored in. That means the profits or the surplus that belongs to the shareholders. Typically, when you drop a balance sheet, Lax, you have the reserves and surplus that comes out. Reserves and surplus are nothing but the profits from the operations, as well as profits from one time the other income sort of. So those are the things that goes into the reserves and surplus. Part of it is plowed back into the business, and part of it is divided among shareholders as dividends. This is post-tax, post all the liabilities, right? So what happens in the Indian context is this reserves and surplus that is available typically gets plowed back into the business to fuel further growth. So if you are which is probably why, just as an example, all these years Apple never gave any dividend, right? Many stocks, Microsoft never gave a dividend for many years, and then they were forced to start giving dividends. Why? Because they see that they have come to a point where further new growth avenues are either impossible or too risky. So what they do is, instead of putting money into the new investments, they give part of it back to the investors. So when you start seeing more and more dividends, it's not necessarily a good sign. And when you see dividends coming higher and higher, it could be on two reasons. One is your dividend yield is total dividends by the share market price or your purchase price. If it goes down, if the dividends yield increases, that means the company is not seeing any new avenues, and that is that could be a worry. So I know you need to question yourself: are you in the right company at all? I'm not saying higher dividends necessarily translate to a bad company, but if the company continues on a sustained basis to give very high dividends, it's not a good sign, because that really means they don't see avenues for growth. And as the shareholders, perspective, you really want to see your EPS growing, year on year, right? So high dividends doesn't necessarily mean a good thing from a growing economy's perspective. Did I answer you?
Yeah, you did. And that concern, I invest in a lot of dividend stocks. High dividend actually causes a lot of concern to me, given the nature of the stocks that I invest in. So, well taken.
Yeah. Well, there are some companies though where if you've entered early, you really don't have to worry about it. If your entry point is say ₹1 or $1, a $80 stock, gives you capital appreciation plus the dividend. So the net yield on any investment is significantly higher, and you can take it. You don't really have to break your head there, unless you see other companies that can give you even better returns there. And again, time to time you got to look at your portfolio and say, do I see better opportunities for investment? And if you have the appetite to look at that, sure. Otherwise, just let it drift. That's not a problem. Okay, I think we have covered this. Now, this chart is very focused on the Indian stock market. There are some long-term stories that I would like to highlight. There are some things I think people should avoid. When I look at the long-term stories, the banking is one of the biggest areas. Without the banking sector growing, there's no Indian growth story. So I'm assuming that we all invest in the Indian growth story. If the Indian growth story is not there, I don't think we'll be in the stock market. As simple as that. So banking is one of the most critical areas. Typically look at the banking stocks in the Nasdaq or Dow Jones. They form a significant percentage, and so is the case with the Nifty or the Sensex. So banking stocks should be invested at every available opportunity, and within the banking stocks, I would pick on the private sector banks more than the PSUs, the public sector undertakings. Why? Because PSUs are governed by government's whims and fancies. They are forced to open into remote areas, for social obligation purposes. Of course, private banks are also being forced into opening into rural areas of late, which is good to see, because that will put things on level playing field with the public sector units. But in spite of that, they have been managing their NPAs, or net performing assets, much better than the public sector units and as a whole. So there are two parameters that you look at from a banking perspective to see whether they are growing or not. One is the NII, which is the net interest income. That means out of the spread that a bank gets, spread is different. The difference between the cost of borrowing and the cost of lending for a bank, not for us. So they borrow from the individual investors and from institutions at a certain rate. So today, if you go as an individual investor and invest, say, 6% in a fixed deposit, that means the bank's borrowing cost is 6%. What do they lend you at? Maybe at 14%. If you go for a car loan or a house loan, the interest rate is 12 or 14, whatever the number is. That is typically higher than what the banks get from you as a deposit, and that is called the spread. So the higher the spread, the more profitable the bank is supposed to be. But that's a very simplistic way to approach it. The net interest income is the difference in the spread, but this is only one part of it. There are other interest incomes that are available across the bank. Different corporates have different ways of different instruments and different ways of investing and taking money out. So the sum total of it comes to the NII, or net interest income. So that is one of the keenly watched parameters. Is the NII increasing for bank on a sustained basis? That's question number one. The second one is the NPA, the non-performing assets, as a percentage of the total assets. Anything more than 3 or 4% as a thumb rule is considered bad. And today, if I look at the PSU NPA, it's about 7 to 8%, which is catastrophic by any stretch of imagination. Contrast that with, say, some of the private banks like HDFC Bank, which has about 0.8%, or ICICI, which is about close to 2.2%. ICICI is probably the worst in terms of the NPAs amongst the large private sector banks, but even they have done much better than the PSUs. So the NPAs and the NIIs are the two key numbers that one would watch out for in the banking space. And as long as you see them growing consistently year on year, it's good to be in private sector banks rather than PSUs. The one exception within the PSU domain space is the State Bank of India. And why I'm saying that is because most of the government money lies with State Bank. The army guys' pension, the central government employees' pension, all the treasury operations, everything lies with the State Bank. So you really cannot miss State Bank. It's the biggest of them all. But all other banks, I'll probably take it with a pinch of salt. All the public sector banks, private sector banks, there are many very good stories. My personal preference has not been a bank, but a housing finance company, which is HDFC. I've been in that stock for about 15-20 years now, and I've seen my wealth grow multiple times just because of that. It's one of the best stocks you can never hope to. But if you look at it on year, it'll give you 10, 15, 20% growth, and nothing more now, even on the stock basis. But you can pick such stocks and stay on it for the long term, and your wealth certainly grows. Insurance sector, I haven't seen any great growth stories in India as yet. Probably because insurance is still a very fragmented market, in spite of all the hype that you see in the media. The insurance is really yet to touch the poor and the middle class. In the strictest manner of speaking, and poor may not be able to afford insurance on their own. So I'm not very gung-ho about the insurance sector, but there are a couple of players there who claim to be good. Max Life Insurance, I am not gung-ho about it at all. NBFCs, which is non-banking financial corporations, this is another area which to me is very, very promising, like the private sector banks. NBFCs typically constitute companies in the banking space, on the finance space, that are not holding a banking license, but are in the in the business of funding operations. Nevertheless, let me give you a couple of examples. One is Shriram Transport Finance Corporation. That is a company that is very focused on truck finance, and they are the #1 in the country, and their growth has been phenomenal over the years. Sundaram Finance is another. It's an NBFC. They don't have a banking license, but they have been lending, borrowing from the money from the public and lending at very lucrative rates, and they've been giving very steady growth as well. So there are a few NBFCs that people can look at for the long term as well, apart from private sector banks. So banking, certainly it should be in one's portfolio if you want to build a long-term portfolio for yourself. The other big area that I see having long-term prospects is pharma, and pharma is not considered a very glamorous sector, but if I look at the performance of pharma stocks over the long term, they've been very good. It's not as good as the banking stocks, but they've been phenomenal. At least for me, I hold a few pharma stocks. Lupin has been one of them. I've been holding for 6-7 years, and it's given me stupendous results for the last 6-7 years. Dr. Reddy's Lab. These are two of the large caps, Sun Pharmaceuticals. So 3 would be in the large. There are a host of small caps, mid-size companies. We'll come to the list in a minute. The other area is FMCG, which is the foreign-made consumer goods area. This is again the likes of Hindustan Lever, and although all those companies fall under the FMCG, this is a consumption story. This is a consumption story based on the India growth story. This is a consumption story based on the India rural growth, and this is something you don't want to miss out, especially with the proliferation of all products and services into the rural sector. FMCG is one of the best places to be in, and it's considered a very defensive sector. So that means when these stocks fall rapidly, these are considered safe havens. Typically, ITC, Unilever, etc. Marico. I know there are quite a few companies. I'll come to that in a minute in terms of the actual list. Infrastructure stocks, and again, India growth story cannot be complete without growth in infrastructure. But I put this in the last of the pile for a reason. We saw this hype being created in the infrastructure in the 2004 to 2008 boom, and a lot of companies did very well. If you were an investor in those companies, you caught them early, you would have minted money if you had exited in the 2008 period before the meltdown happened. Post meltdown, people really start seeing the true picture. And what really is the true picture? These have been very small companies, very little capital. I've seen companies with capital as low as 5-10 crores, playing in the infrastructure space, which is quite laughable, because infrastructure by definition needs a lot of capital. So it has to be capital intensive. But unfortunately, most of these companies, in fact, no Indian company, it's very strange, no Indian company has had a huge capital base. Even the biggies like L&T, you look at their capital base, they are a pittance compared to what you would see with, say, Caterpillar or one of these construction companies in the US. So these are really capital intensive, and one needs the fiscal discipline to make sure there's financial closure on many of these projects that they bid for and win before they can move on. Unfortunately, what they do is they go on borrowing, and they go out of control in no time. There are many real estate companies which are on the verge of bankruptcy. People don't talk about it. The DLFs of the world, Unitech, all the big boys are on the verge of, if you're purely going by the financial balance sheet, their net worth is negative at this point of time. I still wonder why people are in those stocks, but that's a different story. So the point here is infrastructure is a damn good place to be in. It is the future for the Indian growth story. However, one has got to be very, very careful and choosy when it comes to infrastructure stocks. I will give a couple of my recommendations in a chart that I'm going to talk about. What do you do with cyclicals, or cyclicals, whatever they call? Do we get into cyclicals? Cyclicals typically are stocks which are in sectors that are considered cyclical. That means, for example, automobile has a 6 to 7 year cycle. That means automobile stocks and therefore their sales and revenue and growth go for a 5 to 6 year period, and then they ebb off for about 3 to 4 years, and then they pick up again, and so on. This is a very cyclical business in nature. The steel industry is very cyclical as well. You have segments like sugar, which has been in a long-term downtrend, but it's a matter of time before it picks up, because these commodity-based businesses usually typically cyclical or cyclical. So would one want to be in that? Again, it depends on what level of maturity the individual has. If you are a newcomer to the stock market, I would say avoid cyclicals. They may be attractive on the face of it, but they are fraught with a lot more risk than the established ones are. So if you're savvy enough to pick the ones at the bottom, then you can go into cyclicals and you'll definitely mint money. But if you're not, then you're better off staying away. Okay, so here are some of my picks for the markets, and I'm not putting it in any particular order. If you look at the left column, the top few are in the BSE Sensex 30. HDFC is my top pick. Lupin has been my favorite. Sun, Dr. Reddy. So there are 3 pharmaceutical companies, large cap stocks in the pharma that I really like. I like L&T for the long term. Again, they are one of the best managed companies in the infrastructure space. So if I want to ride the infrastructure boom, then nothing better than L&T. So if I were an investor wanting to get in today, I would start accumulating L&T at this price. ITC again has been my favorite because of the fact that they are in the consumer industry, and the cigarettes, notwithstanding all the increases in taxes, continue to be profitable and make more money than ever. And ITC is branching off into other consumer areas that Britannia has got into as well. So, they're into the foods business, and that is going to be quite profitable for them as well. ICICI Bank has been a very aggressive bank, but it's down the order for me, probably because the NPAs are probably the worst amongst the private sector banks as I see it. So, but there is an ample scope for growth, and I think they will go. They will be going on a capital expansion spree shortly, which really means good for the investors if they can take advantage of the rights issue as and when they come. They may even go for a bonus issue. I don't know. So ICICI Bank has been a good pick, from a long-term perspective, but they need to bring their NPAs down. Britannia has been my favorite. They've been doing a quiet job. The management has changed, and forgot the lady's name. She's turned around the company and it's doing phenomenally well. They're on a nice growth track, enviable position. Even at today's price, I would recommend accumulating Britannia and ITC, I would say. Havells again has been a play into the okay. So until ICICI Bank, it's the large cap. The rest of them are mid cap stocks, starting with Britannia. Britannia is a damn good story. Havells, Page Industries. Now, Page Industry owns the Jockey brand, and Lux and guys, and I'm sure you would see Jockey, brand name being brandished in every major city. Go anywhere, at every street corner, you find a Jockey store. You find the brand having the maximum visibility. Now that should tell you that the stock is in for the long term. They are the dominant player now, without an iota of doubt. They've overtaken all the other players in the innerwear segment. They are also diversifying into ready-made T-shirts and things like that. So more finished goods than just the undergarments. And they are the market dominant leader, so nothing better than them to stay there. Their capital base is hardly 12 or 13 crores, which will give it a nice scope for expansion going forward. So definitely it's one of the places to be in. Havells has done well in the past. They're going through a round of consolidation right now. They bought a company called Sylvania Lakshman about a couple of years back, so they're still in the process of digesting it. Once they're through with it, I think their profitability will start improving. Havells again has been very aggressive in the marketplace. Again, you see very high visibility of Havells products, starting with tube lights, your switches and all that. Havells certainly is taking the dominant position, and I would want to be in a place where the dominant player is. WABCO is again a Warren Buffett investment in the auto ancillary sector. They have done phenomenally well. I expect them to grow further as well. Bioscience Corporation is in the agri area. Bioscience and Monsanto, two of the agri businesses that I really like. They're very stable and they are expected to do very well. Sadbhav Engineering is one of the best performing infrastructure companies. They are leveraged all right, but the good thing about Sadbhav is every time they win an order, they are able to achieve financial closure really quickly. Now, what really is this financial closure? Financial closure really means that when you get a project, it's a capital intensive project. Not every company has the balance sheet ability to leverage its balance sheet and put money into the business for that particular project and be able to complete the project on time. So they go to third-party finance companies and institutions to get the requisite capital to get this going, and sometimes they give a capital share into that particular project, or they just take it as a debt. But either way, they make sure there's enough capital available for the project to go ahead. So that's what is typically, termed as financial closure in the infrastructure company parlance. So Sadbhav has been one of the best in business when it comes to quick financial closure, along with L&T. So I really like Sadbhav Engineering from that perspective. IndusInd Bank has been a much smaller private sector bank. They have been growing rapidly, and I expect them to continue that growth path. Motherson Sumi, Bosch, Eicher Motors, all three are in the auto space. Now Bosch and Motherson Sumi are in the auto ancillary sector. They have been performing phenomenally well, very strong managements. I would love to be in that space any day. Eicher Motor has been a revelation, has been a miracle of a turnaround. Ever since they bought Royal Enfield, which makes Bullet bikes, Bullet used to be very, very staid, and people wouldn't want to touch it. But over the last 5-6 years, they have done a phenomenal turnaround job, and they are growing at almost 45% year on year for the last 5 to 6 years, and it continues. And I don't see a reason why we cannot be there. So Eicher Motor certainly is one of the areas. There's one area which is a sort of quite sweet spot, which is Castrol. Castrol is in the oil additives business, and again, as long as there are cars and two-wheelers in India, you will see Castrol as a dominant player. The good thing about Castrol is it is benefiting from every dollar drop in the oil price, because the crude oil is the input for Castrol, and conversely, when the oil prices start going up, you should typically see Castrol's profitability getting affected. But at the moment, Castrol is doing very well. I don't see why we cannot take advantage of it until the oil prices stop crashing. But that's, again, the management is damn good. The good thing is, when there's a cost of oil price increase, crude oil price increase, they're able to transfer most of it to the end consumer. But when there's a drop in the oil price, they don't pass as much to the consumer, so they just retain most of it. They just give very little to the end consumer. So that adds to the kitty very much as far as Castrol is concerned. Very strong management, damn good long-term buy from the mid-cap space. IRB Infrastructure is very similar to Sadbhav. They are into the road space, mainly into the road construction. They are able to achieve financial closure fairly quickly, and theirs is a sort of annuity business where the tolls collected from the road make up for a lot of their revenue, and that has been increasing by the day. They are largely debt-free company, which is very surprising for an infrastructure company. So IRB certainly would be one of my good picks for infrastructure. Sundaram Finance is in the NBFC space. We spoke about it earlier. So STFC is Shriram Transport Finance Corporation. Cummins again is a play in the India growth story, because when manufacturing has to go up, Cummins will certainly come into play. And a very strong management, damn good set of products. They've been there for a long time, sustained good growth. There's no reason why not to be in Cummins. Asian Paints, again, the market leader. At the moment, they are gaining immensely through the crude oil price drop, because crude oil again goes into the intermediary and the pigments that go into making the paints. So any drop in oil price adds to the bottom line of Asian Paints. They hardly pass on anything to the end consumer. But when, again, conversely, like Castrol, when the prices go up, they pass it on to the consumer. At this point in time, the real estate market is low and dormant. Therefore, their profitability is not growing as much as they would like to. But the day the real estate starts turning around, Asian Paints would be back in this business big time. And they are the dominant market players. I would strongly recommend going into Asian Paints at every depth. So these are some of the stocks that I picked for myself. I have holdings in many of them. I'm waiting for an opportunity to get into a few of them, but my own experience in the stock markets is wherever I've gone with the hype, I've lost money heavily. But wherever I've picked on the staid ones, the quiet ones, I've definitely made much more money than I hoped to. So my own lesson in the stock market is, don't ride on the hypes. If there is somebody hyping up a stock, first thing is to get out. Don't hire unless you are savvy enough to press the exit button at the right time. Okay, so let's probably the last chart here in terms of the. Oops, I missed it. In terms of the mutual funds and ETFs that you asked, So if you're investing from outside of India, there are three ETFs I really like, Lux. One is the Indian consumer thing, INCO. That's the ticker code in Nasdaq. That rides on the consumer thing in India. So the consumer story is here to stay, and I'd like something like INCO to perform well. But look at the performance; they've done fairly well. INXX is the infrastructure ETF. That again, if you believe in the infrastructure story, INXX is the place to be in. Indy is the one that tracks the Nifty, so that will give you a Nifty rate of return. So it's a much safer place to be in, but again, returns would be muted. So if you're looking for safety, Indy would be the place to be in. The one thing I'm missing, and I'm not aware, is there appears to be no ETF for the banking sector. Now, if there is one on the banking sector, I'd love to be in there, because without the banking sector growth, India growth cannot sustain, in my opinion. Banking and infrastructure are there to be, ridden upon. Three mutual funds, fund houses, I would say. The appropriate product, it depends on country to country what's available in your market. That you should pick. The three good fund houses have done a good job, in my opinion, from an outsider's perspective. Franklin Templeton, Aberdeen, and HSBC. Now, of all the three, HSBC is a high risk, high reward. Aberdeen has been the most conservative, and I personally find Franklin Templeton to be a good mix of both. So my preference clearly is for Franklin, but if you want stability and conservatism, then Aberdeen is the place to go. But if you're not risk averse, then HSBC could be a place. But again, HSBC at this point of time in the market, I would probably wait for the market to correct a little bit to get into HSBC. So the losses in HSBC mutual funds have been higher than the others when the markets went down. I've been observing it, but when the things go up as well, their returns are much higher. So they have a much higher beta than any other mutual fund. From an India perspective, there are again three fund houses. One ICICI is good. The Prudential Discovery, which is the small cap fund, which is again if something you want to play with high risk, then that's the place to be in. HDFC Top 200 has done very well. DSP BlackRock Top 100 has done very well as well. So there are many 5-star performances in the Indian stock market when it comes to mutual funds. But again, you got to really test these guys out when the market is on a downtrend. So in the 2006 to 8 cycle, I really never focused on the mutual funds because I was more focused on as an individual investor. But after 2008, I started actively looking at the mutual funds, and I like these three the best. I'm sure that there could be Canara Robeco is another people say is very good. Birla Sun Life is good as well, they say. I don't know much about them, to be honest, but these three I certainly like. So let me stop here, Lux. That gives brings it to an end in terms of what I wanted to cover. So let me stop here and throw the floor open for questions.
Hi Dilip, very good presentation, Magesh here. Yeah, based on it looks like you've done a lot of research on the Indian markets. So based on that, where do you see? Is it at the peak, is it the end of the bull market, or you see this as only a correction? Because somewhere you mentioned this could go up to 1/3. 1/3 is almost like 33%, which is more like a bear market. So normally corrections are maximum like 10-20%. Anything more than 20%, they take it as a bear market correction. So do you think this is a bear market correction or is it only a short-term correction?
Okay, there are a couple of good question, Mahesh. There are a couple of underlying things, and we covered this partly as well. One is valuations of the Indian market, as expectedly, are higher than the other indices. So, and that is not unusual. But in terms of absolute numbers, we are about 23.5, which is very high. Now, if the earnings pick up, then that may not be bad. But from what I look at, earnings could be muted in the next 6 to 12 months. The reason for that are a couple of things. One is the monsoon is not as great as it is made out to be, so that is a sentimental dampener more than anything else. So that could pull back the stocks a little bit. But more importantly, there are a few legislative proposals that have fallen flat on the face. The monsoon session was a complete washout. No business was conducted. GST was not pushed. Well, the government was not able to push through the GST, which to me is a huge setback. A couple of good things that they have happened is the insurance industry is getting a boost with up to 49% investment allowable in insurance industry from foreigners, which is good for the industry. But overall, in terms of the market itself, the GST is certainly a dampener. Earnings growth is likely to be muted in the last this fiscal year, which is likely to end by March. So that means the next 2 quarters, I don't see great growth coming in from the corporate sector. So I think we are peaking out. I'm not saying we are dropping here. From here on, the risk to reward is very high. That means for every money you put in, every dollar or every rupee you put in, the rewards may be muted. That's an opportunity. Sorry, let me finish. This assumes that there's no major geopolitical event that will pull down the markets. I see a couple of undercurrents, and I'm waiting to see how things shape up. One is the price of gold that I mentioned. That continues to slide, and that's a massive worry for me. Oil, I'm not worried for now, because any drop in oil price is good for the overall global economy, is not good for the oil producers. But the oil producers luckily don't contribute as much to the global GDP as the other biggies do. But it's not as simple as that sounds. Lux and Magesh, I'm sure you guys have seen this as well, right? A couple of I think it's BlackRock or somebody who it was. No, KKR. Sorry, KKR's oil funds have gone under. You guys are aware of it, right? They've gone bankrupt. They filed for Chapter 11 bankruptcy. So I hope this contagion doesn't, because with every fall, these guys are heavy oil hedgers, right? Now, I don't want a situation where Lehman Brothers is being repeated here. I'm just waiting to see is it a repeat of Lehman Brothers, or it's just a blip in the radar. I don't know at this point of time. I'm not knowledgeable enough, but I'm watching it very keenly. I don't know if this is going to flare up, because further fall of oil can put many of these guys out of business. And again, the shale producers in US and Canada, they're also under threat. There are two views here. The cost of shale production is going down, but it's still not there yet. So that means many of the shale producers may also go out of business. Now it may be as simple as a few normal businesses going out of business, resulting in very little impact. It may be catastrophic as well. That added to the fund houses, the KKR types of financial institutions, could pull down the US market. It could, but I'm not saying it will. At this point in time, I don't see any signs of that yet. I'm watching it very cleanly. And if the US market, and therefore by definition the rest of the world, goes down, there's no reason India would stay where it is. It will also go down along with it. As far as India market, standalone basis is concerned, I don't see any triggers to the downside right now. I don't see any triggers to the upside either.
Right. So we got the upside part, right? But downside, you see my chart now, right? So this is S&P for the last 20 years. Now, you threw in a number of 30% down. It has happened, but it has happened 2 or 3 times. But the typical correction of 10 to 15% is what I think we would expect in this market. Maybe I'm saying this because we are already at 10%, but there's no, even with oil and shale, will impact a lot of US firms. US firms could go down, and it could really bring things down. But I personally don't see a reason why it would do 30%. The only objection that I would have to that chart is that number, 30. 30 is possible, but it's not probable.
Yeah, it's, certainly you're right, Lux. And I don't see, as I said, I don't see that happening at this point of time, unless there is some undercurrent that could pull the market down. People say Chinese economy will drag it. I don't think so. Chinese economy, if it drags down, will be temporary. The market will bounce back pretty quickly.
So let's talk about that, right? So yeah, so we got that objection through, and then that number is a scary number, and yes, we would complain that the bears are using scare tactics to throw in a huge number where it's not probable. But let's not beat that horse to death. The Chinese currency going down, there is a number that's being thrown around, which is 20%, further depreciation. How would that impact India?
Oh, it will severely impact India as well. But not, relative to the rest of the Asian currencies, I think India will be less impacted, because the trade equation between the rest of Asia and India is still very minimal. Right? Now, There's no reason why the Japanese yen will stay where it is. There's no reason why the Korean won will stay where it is. There is no reason why the Singapore dollar will stay where it is. Already, if you look at the chart, let me take you back to this particular chart. As you can see, Singapore has lost 13% against India losing 8%.
Dilip, I think there may be a pop-up on top to say, do you want to share to everyone? Just say yes. Oh, no, okay. I think I can press your thing. Magesh, you can press on the presentation. Now I can see it. Okay, no worries.
Okay, so I'm back on this chart. India has got about 8% depreciation. Singapore has already lost 13%, very quietly, without creating any fuss. Why are they doing it? Because they see the rest of the Asian currencies going down quietly. So if you look at, say, Japan, you look at Korea, they are all going. Korea is probably not here in the list. No, it's there. Korea is 17%. So if you look at the major Asian currencies, they are all export-oriented economies. So if one big guy drops his pants, the rest will quickly follow. So this is exactly what happened in the mid-90s during the currency crisis in Asia. I'm sure you guys are aware of it, right? Namala, you would have been in college or something like that at that point. I mean, some of us would have been doing PhD, some of us would have got into a jobs, but we all have heard about this Asian currency crisis. In India, we were practically not impacted at all, but Asia was in turmoil. I remember, and I used to work in this part of the world even at that time. I used to fly in from India, and we used to price our contracts in US dollar just to avoid any further meltdown in the currencies. The Indonesian currencies just melted. I mean, the whole region goes into.
Right. Yeah. No.
That mean for India?
Yeah.
On a comparative scale, we don't have that much of exposure. But if the overall Asian economies get pulled down, a currency crisis happens here, then we will be impacted. Now, is this 20% enough to trigger a currency? I definitely think it is. Now, is the Chinese government dumb enough to pull the trigger on one day? I don't think so. Right. They will do it very slowly.
Yeah. Right. I guess that's the consensus, that it would kind of go down, but the bleeding hasn't stopped. But yeah, so the answer is it will not impact India as much. Now, that said, we are already an hour and a half, but let's talk. I don't think anyone will listen to it this far. But I was actually looking at the charts of the things that you mentioned. Can you guys see Magesh? Do you see my chart? If not, just click on the chart.
Yeah.
So this is the India Consumer ETF. Yeah, that sounds very interesting. And here is the India Earnings ETF. This is one thing that I've been looking at because, I don't know, Baron suggested it. I think they used EPI more. Magesh, do you know that if they use, the others that he mentioned, IDXX and INCO, he mentioned INCO, INXS. I just followed EPI. So I'm going to do a study on that to find out. The one thing that's dramatically down is the infrastructure ETF. I just want to see that a little bit more in this context. So, I wrote down some questions in that Facebook group.
Sorry. Can you just go back to the India infrastructure ETF?
Yeah, 1 second. I think a related question I had, bring about. Here's infrastructure. This is 5-year.
Right. Now, if you see, it's a practically downhill ride, right? This directly relates, if you just recollect, the GDP has been flat over the last 4 years. And that's because of the fact that the infrastructure is tanking. And why is infrastructure tanking? Because policy decisions are not being made. A lot of court cases are holding back infrastructure spending. So until and unless those are released, you are not going to see this pick up anytime soon. Right? That's one.
So
the other thing.
Yeah, Modi has the mandate, right? I mean, what cases are you talking about? These are local state cases, no?
No. There are the coal mine blocks are stuck in the Supreme Court. So without the Supreme Court, the Supreme Court has released some of the blocks. They've already been handed back to the industry, right? Now there are many more blocks which are part of this coal scam. That if you recollect, Lux, on the coal scam, Karatala, all the coal blocks were completely frozen. Entire coal mining activity came to a standstill, barring Coal India. Right. Apart from that, all private sector mines were completely frozen. Now a few blocks have been released. Out of the 213 blocks, about 20 or 30 have been released. So still about 80 to 90% with the Supreme Court awaiting cases to be settled. Until that happens, expect this chart to look ugly.
Wait, so does that also mean that if a court result comes out on a particular day, this could jump up or down dramatically?
At an ETF level, I don't expect that kind of a dramatic change. At the individual stock level, a Sesa may go 20%. That's possible, and Adani may go 20%. That's possible. But at the ETF level, I don't think that you'll see that dramatic change.
Right. Okay. Okay. That's good because I didn't understand. In fact, that was one of my questions. Why is infrastructure tanking? So tell us about Modi. So is the honeymoon over? And there's a huge expectation, and FPI is increasing, right? Why isn't the funds going up? Why aren't?
Okay, so the first question first: is the honeymoon over? Clearly, it is. I mean, it's 1.25 years. People cannot wait forever. Second one, why is he not delivering? As I said, this is not a shifting of blame, but the fact is, many of these are stuck with the courts, and until and unless that is released, it's going to be impossible to move on. Third of all, people miss out a very key point, is a lot of excess capacity has been created in the last few years, and it will take time for the industry to absorb that excess capacity before further additions to capital or capital formation is formed. The only way this can jumpstart and go to the next level is when there is fresh capital that will come in and start doing some of the stuffs. So, for example, the $5 billion investment in Foxconn, that's going to do in Maharashtra, that's a case in point. That $5 billion is going to add directly to the capital formation within the country, and that will start getting more jobs, and therefore the ripple effect will happen. But that is going to take time. So what we are seeing today is Modi is taking a lot of right steps towards infrastructure investment, but that will take time to fructify and come out. What he is not doing, as I covered earlier, Lux, is continued ignoring on some of the key social sectors, things like irrigation, water management, health, sanitation. Practically nothing is happening. Education, practically nothing is happening there, and that's a big worry for me, because while it's good to have some of the sectors get the focus they need, the other sectors are being ignored, and I don't like it. The good thing is, things like Make in India will certainly help this, but these are all long shots. These are not going to, get this ETF change its direction overnight. They will happen over time. People have to be patient. People are running out of patience. Both are facts.
Now, I'm not getting into any politics, but is that there are a couple of cases from 2002, and if they actually get somewhere, this could be a problem for Modi. Is that something that's possible?
Come again?
Like I said, without getting into the politics of this, the 2002 Godhra cases against Modi, which are being apparently rekindled, is there anything to it? And then could that actually have an impact on the government?
Okay, so matter of factly, Godhra has been set aside by the Supreme Court. I don't see why there should be any further discussion on Godhra. I mean, Modi has been personally absolved of any crimes in the particular thing. Now, the cases are still going on in the Gujarat High Court on specific counts, and from an economic standpoint, I don't see why they will impact the overall economy, whichever way the judgments come out, unless and until Modi is personally pulled back into a case by any fresh evidence that may surface. At this point, that appears to be none. At this point, these are specific cases. I don't see that impacting the economy in any way.
Right. Okay. No, fair enough. I think that's from a stability perspective. Now, I'm a left-leaning liberal, so I'm not a big fan of conservatives coming into power. The one concern that we always have is they would actually, religion will take hold of things. Is there any such worry that RSS or one of those guys would wield too much influence?
I don't see any of that, affecting any policy decisions. First of all, I don't see any influence on religion affecting the common man's life. There are sporadic incidents that have been reported by the media. They have been blown beyond proportion. Some of the church attacks, for example, were attributed to some of the right-wing guys. The Delhi government has done a investigation and concluded that they have been, standalone events. Guys playing there, throwing stones at church windows, and they breaking and people crying horse. Media is doing what it needs to do to get its TRP rating, but at the national level, I don't see any of that happening. For example, another Ram Janmabhoomi kind of a thing or a Godhra kind of a thing. Unless that even happens, I don't see any such flare up. And certainly that's not impacting the economy at this point of time. Whether it will impact at a later time, we'll have to wait and see.
Okay, perfect. That answers the question. Now here is the EPI, the India earnings ETF that I was following, right? For argument's sake, let's say this actually represents the market, which it doesn't, right? I mean, I kind of knew from talking to you. Now I just, look at some support levels and then say, okay, when it hits it, I will buy a little. I don't have to buy it at the best price. Now, with the markets pulling back, do you think this is actually a time to visit this, or do you think we have to wait a while?
Okay, let me ask you a counter question. Why are you hung up on the ETF? Why don't you go with, say, HDFC Bank or HDFC? Because both are listed in the US market.
Right. Now, I think I don't have an Indian account, so in my case,
you don't need an Indian account. All you need is a Nasdaq or a NYSE account. These guys are listed in Nasdaq.
No, HDFC.
Dilip, sorry guys to interrupt. I'm going to drop off.
Yeah, later.
Bye. Yeah,
so HDFC. Stop it. Okay, good night. HDFC is there's an ADR. ICICI, there is an ADR, right? Yes, we can actually do that, but looking at something that would truly represent the entire market, if there is one such thing, would be a little bit more appealing if you're not following those things. That's why. So again, for argument's sake, if there is an ETF that actually represents India now, which is tanking as all others are doing, does it make sense to wait a bit? That's a general question, let's say, for anyone who's investing in mutual funds as well.
Yeah, that's true. So just do an SIP, as simple as that. So then you don't have to worry the market tanking or going up or going down. You'll get muted returns, but your capital will be protected.
Right. Yeah.
So if you're asking me whether this is going to go down, chances are it will. If you really ask me, chances are it will. As I said, the other post that I did on Facebook, the 200-day moving average is broken down, so I clearly see a correction coming. How far it's going to go, I really don't know, because it all depends on how the global events play out. We are in a slightly fluid situation now. We were in a period of stability. Now that unstable feeling is coming all over again. So definitely we are in for a correction. How much correction we will have, I don't know at this point of time.
So when it comes to Nifty, so if S&P tanks, Nifty also tanks, but the magnitude of the pullback is higher, could be higher in Nifty. Is that a fair statement, comparing the few pullbacks in the past?
Yeah, I would say rather than the magnitude, the speed of pullback could be higher.
Why is that?
Because the reasons for which the S&P are going down are something related to the American economy, and that has no direct bearing on the Indian economy, because luckily or unluckily, we are not dependent on American exports to sustain our economy.
Right, but the speed at which it comes down, are you talking about individual investor behavior that pulls it back?
Well, it's the institutions that pull it back. Individual investors are a very small fry there. It's the big FIIs that manipulate the market, and I can see some stocks being hammered purposely for that.
Right. So when it comes to the Indian market as well, like the US market, the individual investor is a very small fraction. It's really the big guys that move the things.
Yeah.
Cool. Now, I'll briefly ask about options. Like you mentioned, investing in firms for 10 years or so. I've known Microsoft from the time that I started investing, which is 20 plus years. But I do options. So every 2 years, but 2.5 years is a maximum life of a leap option. So you just keep rotating it. Now, when I talk to people in India, though, options are considered highly speculative, short-lived, and completely whimsical. So I honestly don't talk to anyone about doing options because their impression of me changes completely. Why is that? And is that generally true that it's considered speculative?
It is extremely speculative, and let me tell you why. Typically in India, options are used by large traders, not necessarily FIS, but large traders, as an insurance against the stock price drop if you're a bull, or a stock price rise if you're a bear. Therefore, they usually talk about a naked option most of the time. There are very few covered options that are being discussed in the market. There's hardly a big options market out there, and it's a very pathetic market, Lux. To put things in perspective, hardly anyone talks about leap options. Whether it's a put or a call, leap options, nobody talks about it. And outside of the index options, there's hardly any liquidity. So today, if I buy even an LNT in a September option, the spread in an option is so high that I find it very unattractive to get into that. So the only place where I think there is a little bit of juice left is in the index itself. So if I trade on the Nifty option for this month, or worst case next month, and there's enough liquidity. Other than this, there's practically no interest in any of those options that people are talking about, except for the big fish. The big fish still play around with the bigger options, and because they have inside information on what, say, Dr. Reddy's lab is likely to do, so they go buy up in 1 or 2 months ahead and just patiently wait. And then when the news comes out, they just sell and go. So they make the money and go. So it's a highly manipulated market, very low volumes. People do not know what options mean, and usually it is used for covering your position. So it's more like an insurance. So if I have a large portfolio, to protect myself against any downsides, I just go buy put options, more like an insurance, and I'm prepared to write it off.
Right. I'm just going to give you an example. Hold on. Let me just try to share my screen. If you can see my screen, please do. Do you see my screen now?
No.
Yeah, you see it now?
Hello.
And can you click on that? I mean, if you see the participant list, there would be an image.
Yeah, now I see.
Okay, so present error. So this is Cognizant, right? So I'm just giving you an example of how I trade this. So here is a short call spread, 48.75 to 50. I don't typically do that. It was just experimental. You buy it September 14th and sell it Feb 15th, and that's actually a short period for me. I normally sell it for a while, but the market has been too high, so I had to really pull back most of my holdings. So again, here's the 50 to 55 Jan 2017 call spread, bought on October 14 and sold on August 15, right? Good profits. We're talking about 100% profits or so in this case, but you know how it is, how it works with spread. It can go minus 50% or so fairly easily as well. But my point is, when it comes to ADRs, Cognizant, HDFC, ICICI, the ETFs, they all have long-term spreads, long-term options. I own them. I owned ICICI, I believe. They were fairly stable. The options that are in the ADR and they didn't really fluctuate as much. But I think in the Indian market itself, they do fluctuate, I think. So my point is, options do exist for the Indian stocks. In markets like NASDAQ, they are fairly stable, like others are. But in the Indian market itself, they are short-lived. They don't really go for leaps, like you said, and it's used for hedging primarily.
Yeah, you're right, and I've seen observed the premium on options for the Indian stocks a few years back in NASDAQ, and they were absolutely lousy. Their premiums are very high. I do not know if it has changed now. I've stopped watching the Indian options in the NASDAQ of late. So just watch out for the premia. If they are still juicy enough, then then go for it, because I didn't find them attractive at all compared to, say, what a Microsoft or a Cisco premium is.
Right. So I think the premium itself does not matter if you're doing a spread, because you're buying and selling premium, right? But that said, I think I'm looking at one more example. I'm going to share my screen again. Oops, sorry, one second. There's a permission thing that comes up. And I'm showing this just to give an example. This is ICICI, bought August 13. In August 13, oops, did you see it? Do you see it? The screen?
Mm-hmm.
You don't, right?
No.
Okay. One last try. Come on. Anyway, I was just going into some of the things like ICICI and others. Yeah, the options do exist for long term, and then I've held them for a year plus and sold them. Yeah, they do fairly well. So anyway, options are a different thing. I think we really wanted to focus on people from India to look at the market.
Yeah,
but I think we saw it at 7:30.
Sorry, Lux. When it comes to options, the key question is, why do you want to be in options in India when stocks are, giving you pretty good returns? Pick the right stocks, right? So, from your perspective, from the US, purely at an options position, you have better stocks for options playing, all those covered calls and all those strategies that you do in the Microsofts and the Ciscos of the world, rather than doing it on Indian stocks.
Right. Yeah, so I think in Indian stocks, I think it just works.
It doesn't make sense, because the main reason people use options in India is for covering the positions.
Right. Like if you take Facebook, for example, I do believe in the long-term viability of that. It's very high right now after it pulled back though. But I would buy 2018 options are coming in September. I would buy some of those. And if the stock price is at 80, I buy 50 call for about $33. So the premium is $3, and it's almost like a stock. So I tell people that it's like paying 50% down buying a car. It's not just taking some random option that just goes away. So anyway, that's the thought. So this is great, man. I think your numbers, I actually took a couple of screenshots and posted in Facebook in our group. The numbers that you had about the percent return of real estate with this. I'm going to actually send this to my dad and ask him to take a look at this. Because I personally view that while the stock market is an interesting place for you to understand the sector, see, I look at the other benefits in investing in the market, which is if you are investing in even let's say a technology firm or Dr. Reddy's, you need to understand the firm. You can just invest because Dilip told you to, right? Or you try to understand. Understanding is actually a lot of fun that keeps you in the game. If you look at someone like my father, I think it kind of keeps him in the game. He really needs to know. He really needs to understand and stuff as well. So this number would actually put a different spin on this. So thank you very much for sharing that. That was brilliant, actually, looking at that with a different set of eyes. Cool, man. It's going to be midnight for me, so let me go as well. And you've been talking for a long time. I hope your family doesn't object that you talked for such a long time. But you seem to be, keeping well that way.
Okay.
What's that?
I hope my throat doesn't well.
Yeah. No. You go and rest up a bit. Thanks a lot, man. Bye.
Right.